In this video, we are going to talk about dividend stocks to buy today. So before starting this video, please like this video, and subscribe to our channel for the future updates. Dividend stocks have long been a popular option for investors seeking a steady stream of income as well as long-term growth prospects. Finding the right dividend stocks to buy in the stock market in 2021 could make a big difference in your portfolio returns if you're a long-term investor. Some will wonder, how do I buy dividend stocks? The first move is to search for dividend-paying stocks on financial websites. Comparing a company's dividend yield to that of its business peers is a good way to identify the best dividend stocks. Here's a list of the dividend stocks to buy today. Let's start. Number 10. Sensata Technologies Holding plc. Sensata Technologies is a global industrial technology company that specializes in the development of sensors and sensor-based systems. Motor protectors, circuit breakers, position sensors and encoders, pressure sensors and switches, and inverters and chargers are among the company's products, which are used in a variety of industries, including transportation, manufacturing, healthcare, electricity, and telecommunications. On April 1, 2021, Sensata Technologies revealed that it had completed the previously announced $400 million acquisition of telematics and data insight provider SureGo Technologies Intermediate Holdings LLC. Number 9. Las Vegas Sands Corp., LVS. Las Vegas Sands is a developer and operator of major integrated resorts. The Venetian Resort Las Vegas and Sands Expo and Convention Center are situated in Las Vegas. The Venetian Macau, Sands Macau, the Londoner Macau, the Plaza Macau and Four Seasons Hotel Macau, and the Parisian Macau are all located in Macau, and the Marina Bay Sands is located in Singapore. On March 3, 2021, Las Vegas Sands announced that it had reached an agreement with Apollo Global Management Inc. APO, affiliates to sell its Las Vegas assets, including the Venetian Resort Las Vegas and the Sands Expo and Convention Center, for approximately $6.25 billion. Number 8. Rio Tinto. Rio Tinto, a London-based megaminer, may be unfamiliar to you, but it is one of the world's largest materials stocks. Aluminum, copper, diamonds, gold, and uranium, to name a few items, are all mined and processed by the company. Rio stock is not vulnerable to cyclical demand because of its diversified activity and strong relationships with producers and other end users. If one part of the business slows down, the company usually has other options to fall back on to keep things running smoothly. It goes without saying that gold is a store of value in any economic setting, providing a solid base for this company. Only keep in mind that the stock pays dividends twice a year, rather than once a quarter, as most big US stocks do. Number 7. PPL Corp. On the one side, PPL, a mid-Atlantic electricity supplier, hasn't been generous to investors in recent years, underperforming peer utility stocks as well as the broader market. What the company lacks in past results, it more than makes up for with a current yield that is among the highest in the utility sector. Looking ahead, value-oriented investors may be especially interested in the ongoing restructuring involving the pending divestiture of UK operations and the use of the proceeds to expand domestic electric operations in Rhode Island. This would result in a more concentrated and stable service, and given that PPL has increased its annual dividend for nearly a decade, investors should expect these changes to result in sustained income in the long run. Number 6. Iron Mountain, IRM. Since it sits astride an established legacy business and a growth-oriented digital arm that is leading the company into the future, Iron Mountain is an intriguing value play. Iron Mountain started as a record storage company in the early 1950s, and it continues to make money from companies that don't have the space or desire to deal with on-site archives. In addition, IRM also provides digital age information processing and security services. In any case, once IRM has a customer, it receives monthly storage payments, which fuels a consistent and increasing dividend. Its operating cash flow, or cash provided by normal business activities after paying bills, is about $1 billion per year, a significant buffer for a stock worth just $11 billion. Payouts have risen from around 25 cents per quarter in 2014 to about 62 cents per quarter now, representing a 150% increase in distributions. Number 5. Energy Transfer. Energy Transfer is one of the most common, midstream, energy players on Wall Street, and although it isn't exactly a household name, seasoned income investors might already be familiar with it. ET stock, as its name suggests, sits in the center of the natural gas supply chain, assisting producers in transporting and storing the fossil fuel until it is distributed to wholesalers, used by manufacturing businesses, or burned to generate energy by power plants. ET doesn't make the same margins as energy producers when prices increase as a result of this business model, but on the other hand, this stock is shielded from any downside risk because it can charge equal rates in both good and bad times. ET is a stable and secure value asset independent of the wider economic climate, with a market cap of $24 billion and a vast network of more than 90,000 miles of pipeline and related infrastructure. Number 4. Lumen Technologies. Lumen Technologies, formerly CenturyLink, is a telecommunications firm with a high dividend yield. Currently, the firm pays out a dividend yield of more than 7%. The company's legacy internet landline systems have been causing problems. As a result, Lumen has decided to invest in high-speed fiber optic networks. And the good news is that the new investment is paying off handsomely. If the company maintains its current momentum, margins could increase dramatically as it continues its pivot to fiber and business services. The company recently held an Analyst Day presentation for shareholders, during which it showcased exciting company innovations. The business highlighted collaborations with VMware, IBM Cloud, and T-Mobile during the presentation. With these tangles of alliances, no one can say for sure what the company's future holds. However, if Lumen clicks with one of these partners, things might turn out well. Number 3. Pfizer. Pfizer has been in the news recently, and we all know why. It's because of its COVID-19 vaccine. For a long time, income investors have favored the firm. The latest dividend yield on the drug maker is 3.9%. The FDA granted the company permission to administer the company's vaccine to adolescents aged 12 to 15 years old this week. Pfizer, on the other hand, recently released its first quarter financial results. To begin, Pfizer reported a 45% rise in quarterly sales year-over-year to $14.58 billion. The vaccine segment, which brought in $4.89 billion, contributed a significant portion of this revenue. The company's net income for the quarter was $4.87 billion, up 45% year-over-year. With the coronavirus pandemic still a major concern around the world, I wouldn't be surprised if vaccine sales increase even further in the coming years. In reality, it appears that the organization is in a good position to produce strong growth in the coming years. Number 2. AT&T. Next up is AT&T, which needs no introduction. It is also the parent company of the mass media conglomerate Warner Media, in addition to being one of the major providers of mobile and fixed telecommunications networks in the United States. In terms of sales, this will make it the world's largest media and entertainment organization. HBO Max and AT&T TV are two of the company's most well-known entertainment channels. This collection of services complements one another and may be the secret to the company's future success. T stock is currently yielding more than 6% in dividends. AT&T is yet to increase its dividend for the year 2021. However, over the last 10 years, it has maintained a dividend yield of over 5%. AT&T is unlikely to end its winning streak. Perhaps a dividend increase will be announced later this year. The deployment of 5G networks may be a catalyst for AT&T to move forward. The increase in data download speed will help AT&T as customers and businesses look to update their wireless devices. Number 1. Constellation Brands. First and foremost, Constellation Brands is a global leader in the production and marketing of alcoholic beverages. Last month, the beverage business reported better than expected quarterly performance. Despite sluggish demand in bars and restaurants, the alcoholic beverage behemoth reported strong growth in its beer portfolio. Net revenues increased 3% year-over-year to $1.95 billion in the 3 months ending February 28, 2021. Furthermore, cash generation patterns are positive, with free cash flow exceeding $1.5 billion. As a result, Constellation Brands faces little difficulty in maintaining or increasing its dividend yield. The management of the company is positive about the coming year's progress. Net sales in this segment are expected to rise by 7% to 9%, according to Constellation Brands. It's worth mentioning that the company has built plans to expand its capacity in Mexico. This will provide the long-term stability required to support the main, high-end Mexican beer portfolio's future growth. In addition, management expects a high operating cash flow of $2.4 billion to $2.6 billion in fiscal year 2022. What do you think of our video? Let me know in the comment section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.